Hello, everyone. This is Sebastian McMahon from IA Financial Group. I'm back with another weekly economic review, this time for the week ending April 8, 2022. So again, an eventful week in the markets. Interest rates are rising again quite strongly. So that means that you have lots of red on the screen here. So higher interest rates means pullback for bond indices. So on the week, minus 2% for the long index. So year to date, we're at about minus 14%. So maybe if we can look at the bright side of things, after one of the worst quarters ever for bonds, that was the worst quarter since the early 1980s. Now, I mean, investors, including myself, are starting to look at this and say, well, probably a large part of the up move in 2022 is already in the books. So probably over the next few months, few quarters, it's going to be interesting to start adding bonds to a portfolio. So maybe we could have a rebound in the asset class. So we have not yet started adding bonds to our asset mix. We're still underweight bonds, but probably at some point you're going to have some more decent returns there. And I understand completely that if you're an investor, you look at your statement and you say, well, being conservative now gives me more negative returns than being aggressive because bonds are doing worse than stocks. Just look at the TMX long index at minus 14% compared to the TSX, which is at close to plus 4%. So these things can happen. But looking forward, maybe bonds could at least retake some of their lost ground here. Stocks in the red all over the place. Again, rising rates. So I mean long rates. So the market rates that have been rising. This and the upcoming strong hikes from central banks, which I'll discuss in a few minutes. They're bringing the consensus to really think that this is going to be taking a bite out of growth, economic growth. And so that's also the traction. That's also negative for equities. So we're starting to see a heavier tone on equities. So de facto, we are neutral equities in all of our diversified funds. So we're exactly neutral. We have an overweight on Canadian equities and also some Latin America countries. So commodity exporters, that's where you want to be right now with this regime of higher commodity prices. And we make up for that by being underweight in the US stock market, which we feel is expensive, and in Europe because of rising energy prices there. I mean, what's happening now in Europe is going to take a big bite out of growth. So it's not very good for earnings prospects for European companies. So neutral equities, but positive Canada, positive emerging markets through LATAM, and negative US, negative Europe. So this is how we're positioned. Maybe the next step is to be even more negative on equities. We'll keep you posted on how our views evolve. There's still a lot of stories going on and a lot of volatility in the markets. So oil down on the week. The Canadian dollar down in sympathy to that, the euro down, and also the price of gold up on the week, but pretty volatile these days. So if we look at the topics of the week, first the central bank, so the Bank of Canada and their Federal Reserve. So you have two charts here. Both are expected to hike by 50 basis points, so 0.5% at their next meeting. So on the left, you have the Bank of Canada. So the next meeting is next week, April 13 at 10 a.m. Eastern time. We'll also have the monetary policy report. If you're an economic fan, it's a great read. So we'll have that next week, and it's penciled in. Everyone is expecting the Bank of Canada to hike by 0.5%. So it's like two hikes in one. Usually when they move, it's plus or minus 0.25. Now it would be like two in one. And we're expecting more than 150 basis points hike before the end of the year. Markets are expecting that with inflation being so strong. There's a need for central banks to make sure that they establish their credibility, that they're willing and able to fight inflation. So this is what we are expecting. On the right, you have the Federal Reserve. The next meeting then there is in May. So it's May 4th. So Star Wars Day for fans out there. So we should also see 50 basis points hike from the Fed in May. And after that, probably a few more 50 basis points hike through the year. So a lot of tightening is expected. So central banks are expected to slam both feet on the brakes over the next few months. it's strong expectations there. So that brings us to the federal budget that we had yesterday. So we were pleasantly surprised to see that we did not see the addition of many more programs, more spending, because that's what was expected by many economists because of the alliance between the NDP and the Liberal government. And we're not seeing a balanced budget. We're not seeing surpluses. These are things that we think that we should be seeing when the economy is running at this level that we're seeing right now. Full employment this morning. More on the employment in a few minutes, but the unemployment rate in Canada fell to 5.3%, which is the all-time low. So we're at the lowest unemployment ever. So that should be synonymous with surpluses or at least equilibrium. So we're going to have deficits all the way to 2027. And one thing that we didn't see that we would have liked to see would have been a very specific target on the debt to GDP ratio. Now, our debt to GDP ratio is still the lowest in the G7, so that's good. But what we see on the right side of your screen here is a forecast. Those are forecasts from the budget. They're not a specific target. So if things change, and of course, before 2027, it's not going to be sunny every day, every year. We're going to have an economic slowdown through that. We might even have a recession before 2027. So these forecasts will be revised. So likely. So this is not the target. These things can move with the next few budgets. So we would have loved to see a specific target and have some more, let's say, willingness to balance the budget, because at some point, if you don't, you're going to have to make some hard choices, like raising taxes, cutting some programs. So when economy is at full regime, that's when you need to set money aside for the future. So, but still, we're not seeing the fiscal policy working opposite monetary policy as much as could have been. So we're seeing that it's good. So Canada's job reports. So we added 72,500 jobs in March, which is pretty good. Of course, it was negative in January because we had lockdowns in Ontario and Quebec in many provinces. Reopened in February, so strong gains in it then, and now March continuing upwards. And when I'm looking at my high frequency indicators like mobility indices, all pointing to a pretty solid month, at least so far in April. So the good news keep on coming for the Canadian labor market. As you can see on the right, we're still ahead of the US in this legit labor market recovery, but the US is starting to gain some steam here. But very good news here on the jobs front. So what to watch next week? Of course, the Bank of Canada rate decision Wednesday, April 13, 10 a.m. Eastern time. So if you still have a variable rate on your mortgage, maybe still not too late to call your financial institution. So you've been forewarned. And in the US, we'll also have some action. We'll have US CPI coming out. It's not a typo. 8.4% year over year is what's expected. Of course, maybe that's the peak. We've been saying that for a few months. I realize that the rise in commodity prices has pushed the peak further through in time. So it's kind of hard to guess where it's going to be. Maybe this is it. Maybe it's going to be next month, but we're starting to see peak inflation, I believe, right here, and we'll have a state of the US economy with industrial production. So that wraps it up for the week. ia.ca/economy. You can follow us on Twitter, on LinkedIn, and there is some new material coming out for Economy and Finance 101 over the next few weeks. Everything has been recorded, now it's being edited. It's going to be posted over the next few weeks. So 3 things: the stock market, the labor market, and the impact of currency movement on your foreign exposure. So that's a question we're often asked. Why does the move in the Canadian dollar impact so much the value of foreign investments? So we did a little something for you on that. So thanks for following us every single week, and I'll be back again next week with another edition of the Weekly Economic Review.